Before we conclude the orientation, we would like to introduce you to the Magnificent Seven. While that name might call to mind a film or a collection of mega-cap tech stocks, we mean something else. For this program, we like to think about the Magnificent Seven as a solid foundation, a set of core principles from which you can build towards financial security. When we say the Magnificent Seven, we are referring to ways of thinking and acting that occupy the intersection in this Venn diagram. These 7 principles relate to things that matter in the context of your financial life, but that are also in your control. The Magnificent Seven can help guide your thinking and behavior in beneficial ways. Let's take a look at each of our 7 principles. This chart from the Federal Reserve Bank of St. Louis illustrates the value of starting to invest as early as possible. Despite the fact that Investor 1 saved a total of $50,000 and Investor 2 saved $150,000, Investor 1 still ends up with a larger account balance as a result of earning compound interest for an additional 10 years. Compound interest is an incredibly powerful force that works in your favor when you are investing and one that works against you when you are taking on debt. This chart from Visual Capitalist highlights the power of compound interest, or earning interest not just on your initial savings, but also on previously earned interest. Assuming a 10% interest rate, the interest earnings very quickly outpace the investor's contributions. The best time to start saving and investing is in your 20s. The second best time is today. No matter your current age, you too can benefit from compounding interest over time. Principle 2 in the Magnificent Seven is go long. You will notice that it is closely connected to Principle 1 and that the sooner you start saving and investing, the more time your savings can accumulate returns. This chart shows the results of 1 penny earning 100% daily compounding returns over 30 days, which is the same as starting with a penny and doubling your money each day for a month. As the table indicates, after 30 days, someone participating in this hypothetical savings scheme would end up with $5.4 million. When most people see a question like the one you just answered in the poll, they start to do some mental math. They calculate 1 penny, 2 pennies, 4 pennies, 8 pennies, 16 pennies, and that's about where someone typically stops and assumes that $1 million up front must be the better deal. Notice that we don't see large sums of money in this table until the last couple of days. That's when the magic happens. The same is true for your retirement savings. It is in those last 10 to 15 years of saving for retirement when your balances really become impressive. A note here about terminology. In this scenario and in some of the other graphs that we have seen so far, we referred to an interest rate. Typically in this program, when we talk about your earnings on your savings and investments, we'll use the term returns. This is more accurate as it includes all the different kinds of profits you will earn on your financial assets. Interest, certainly in terms of traditional savings or when investing in bonds, but when you invest in the stock market, your earnings will come in the form of appreciation and dividends, as at least some of the firms you invest in become more profitable. We want to give you some concrete data to help you think about compounding investment returns. A common retirement savings goal is to amass $1 million by retirement. We entered the data on the right side of this slide into a compound interest calculator to determine that a 25-year-old who saves $250 per month can exceed that goal by age 65. Now, most of your investment returns won't come in the form of interest, but this calculator tool is helpful in modeling other kinds of investment profits. You can see we assumed a 9% rate of return, which is a bit less than the average return of the S&P 500 since the late 1920s. We have made our estimation a bit more conservative by setting the compounding frequency to annual rather than quarterly, the latter of which is more accurate for stock investments. Someone starting to save for retirement at age 35 can also hit the $1 million target by age 65. Given the same assumptions about rate of return and compounding frequency, the individual would need to save $615 a month to get there. These are, of course, not the only paths to a $1 million savings goal. These scenarios assume a constant saving behavior over decades, but many people are able to increase their savings as they gain more work experience and increase their income in their prime working years. We have also assumed that neither the 25-year-old nor the 35-year-old had accumulated any investments prior to these scenarios. On the next slide, you'll have the chance to experiment with the compound interest calculator that we used to create these slides. While we did not enter a value for interest rate variance, you can do that if you want to see how a slightly higher or slightly lower rate of return impacts your balance. The exponential growth that results from compounding returns can be a bit mind-boggling, so we want to introduce you here to the Rule of 72. This is a helpful shortcut for thinking about how long it would take for an initial balance to double in value given a particular rate of return. If you divide 72 by the annual rate of return you are earning on a financial asset, you will get an estimate of how many years it will take that asset to double in value. So for example, an asset earning an average of 8% a year, which might be true of the money you have invested in a mutual fund, would double in about 9 years because 72 divided by 8 equals 9. This rule helps illustrate the power of starting early so that you can go long. If you start saving and investing at age 35 instead of age 45, you can get an extra doubling of your money with those additional 10 years of compounding on your side. On the next 2 slides, you will see what the rule of 72 means for several different rates of return. Balance, risk, and reward is the third principle in the Magnificent Seven. Several times throughout this program, we will remind you that there is a direct relationship between risk, the chance of losing money, and reward, or the returns that you can earn on your financial assets. This graphic communicates that relationship. As you move from the base of the pyramid towards the peak, financial assets become more risky, but also offer the possibility of higher returns. At the base of the pyramid, you will see very safe assets like traditional savings accounts, which are FDIC insured. These assets are very unlikely to lose value, and because they are very low risk, they pay a very low rate of return. At the apex of the pyramid, we see high-risk assets like cryptocurrency and startup companies. Because these investments are high risk, it is only the possibility of very attractive returns that lead investors to purchase them. In third decade, you will learn strategies for managing this risk-reward relationship. You will see that you can maximize your returns and minimize your risk through diversification and by slowly adjusting how you allocate investment dollars to different kinds of financial assets over your lifetime. Principle 4 in the Magnificent Seven is maximize value. Economists are fond of saying there's no such thing as a free lunch. If you think you are investing for free, you are likely mistaken. When you are investing, you rely on the services of financial institutions, and they, understandably, do not perform those services for free. Some providers, however, charge fees that are significantly higher than others. We will equip you with the information and tools necessary to avoid those high fees and hold on to as much of your investing profits as possible. The primary tool that individuals use to invest for the long run is mutual funds, including index funds. This slide lists some of the fees that can be associated with buying, holding, and selling shares in a mutual fund. Often, fees are expressed as an expense ratio, a percentage charged to investors to maintain the fund. There may be fees when you buy and sell shares. If you own shares of a mutual fund through an employer-sponsored retirement savings account like a 401k or a 403b, there may be additional administrative fees. Unfortunately, information about these fees is not always shared in a clear, user-friendly way. With the help of your financial mentor and the materials that we share with you in our classes, you'll be able to investigate the fees associated with any assets that you currently own or are considering purchasing. This graphic highlights the impact of fees on your investment balances. Take a moment to review the effect of different fees over 10, 25, and 50-year holding periods. A 1% fee sounds small, but remember that the effects of compounding over long periods of time dramatically magnifies the impact of fees on your account balance. As you can see here, a 1% fee over 25 years means that you give up 22% of your balance. The fees that you pay as an investor make a huge difference in what you end up with. You should be looking for mutual funds or exchange-traded funds with total expense ratios of less than 0.25%. Fortunately, funds matching that description are widely available now, and investing in them means that more of your savings stay with you to fund your financial goals. In third decade, you will have the assistance of a financial mentor who will act as a fiduciary. That simply means your financial mentor will put your interests first. Whenever you seek professional guidance in relation to your financial plan, it is very important that you work with a fiduciary. There are a large number of advisors that operate on a suitability standard rather than the most stringent fiduciary standard. That means they may steer you towards financial assets that are suitable for your goals, but are also ones that they earn a commission on. Unfortunately, those financial assets may charge you higher fees than similar available options. A fiduciary does not earn commissions, so they are more likely to recommend assets that are ideal rather than simply suitable for meeting your financial goals. A fiduciary can help you maximize value. The fifth principle in the Magnificent Seven is be strategic. This principle is about staying on top of factors that are out of sight and therefore out of mind. 3 of those issues are highlighted here. We will address taxes, inflation, and your credit score in this program, both in the classes and in the conversations you will have with your financial mentors so that you can be strategic. The sixth principle in the Magnificent Seven is to stay focused. On the previous slide, you saw a cartoon that relates to this principle. Financial reporters or personal finance personalities who have their own shows on cable news, for example, can be pretty hyperbolic in their commentary on the financial markets and in their advice to their audience. They tend to promote the idea that there are hot stock tips that you can act on to outperform the market, or that there are times where you should dump big chunks of your portfolio. This will contrast strongly with the message in Third Decade, which is to focus on a long-term plan. Research indicates that people who panic when there is a downturn in the market and sell many, if not all, of their financial assets often do worse than people who leave their assets alone and ride the market wave. So for the most part, we are going to recommend that you ignore what the day-to-day news tells you about what is happening in the stock market. Along similar lines, we advise against checking your retirement savings account balances on a weekly or even monthly basis. The final principle in the Magnificent Seven is pass it on. We expect that this program will be immediately beneficial to you, but we want you to think about the progress towards financial security as creating a positive ripple effect, a multiplier effect that will benefit others too. As you learn more about managing your finances, you can pass that information on to your friends and family, slowly improving the financial health of your community. You may even find yourself down the road able to financially support the causes and institutions that you care about, generating positive effects even beyond your lifetime. Throughout the classes portion of this program, we'll link the Magnificent Seven to key financial concepts to help you deepen your understanding and build a strong foundation for your financial future.